Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Today, we're doing what we do best here at the Deep Dive, really pulling out the key insights from, well, a whole stack of current reports. We're looking at the big names, CNBC, Reuters, Bloomberg. Our goal is pretty simple. Cut through all that noise and give you the most important takeaways.
Exactly. And our mission really for this deep dive is just that. It's about synthesizing all this information coming from different places, trying to connect the dots, between things that might not seem related at first glance, and helping you understand not just what's happening in the markets, but maybe more importantly, why it matters, why it fits into the bigger economic picture. We want to look beyond just the headlines, get at those underlying currents shaping things.
Okay, so let's unpack this then. I think the biggest theme really dominating the headlines this week has got to be the escalating trade tensions, all these new tariffs. President Trump's been, well, pretty busy with some significant announcements, and these are moves that are definitely set to ripple across global markets.
Yeah, it's clear the sheer breadth of these new tariff threats is quite remarkable. It's creating a really complex environment for, well, businesses, economies, pretty much everyone worldwide.
Right. Let's start with our neighbor, Canada. CNBC reported President Trump announced a hefty 35% tariff on Canadian imports. That's effective August 1st. And the reason cited Canada's own retaliatory tariffs, sure. But he also, interestingly, explicitly mentioned the flow of fentanyl. That was notable, even threatening higher duties if Canada keeps retaliating. It's a striking blend of economic and social reasoning there.
It is indeed. And it's not just Canada feeling the heat. Bloomberg reports a substantial 50% tariff has been threatened on Brazilian products. Now, this move really risks disrupting some key commodity markets. I mean, think about coffee. Brazil's the world's top grower of premium Arabica, right? That's the good stuff in most specialty coffees. And prices, well, one major Italian roaster chairman said they could rise quite a lot. That's a direct quote. But it goes way beyond coffee. It hits beef, oil, orange juice. Think about that one. Brazil's huge in OJ exports, ethanol, wood pulp, sugar. It's broad.
And it doesn't stop there, does it? Bloomberg also highlighted a 50% tariff on copper imports, also starting August 1st. That feels like a direct hit on a really critical industrial material. What's the administration really trying to achieve here? And how immediate is the pain going to be for industries, do you think?
Well, that copper tariff definitely seems aimed at, bolstering domestic supply chains. That's likely the goal. But the immediate impact, it's almost certainly going to be a rise in costs, given how much we rely on imports right now. These tariffs, they're expected to hit semi-finished products too: wires, sheets, tubes, plates, stuff that's crucial for power grids, the military, data centers, you name it. So yeah, it's going to raise costs across a whole range of U.S. industries: construction, consumer electronics, you name it. And on top of that, CNBC and Bloomberg both mentioned Trump indicating plans for it, like blanket tariffs, 15% or maybe even 20% on most trade partners. That's a big jump from the current 10%.
And maybe one of the most surprising targets and potentially really impactful is pharmaceuticals. According to CNBC, there's been a warning of a potential 200% industry-wide tariff on pharmaceuticals. Wow. Though there's a grace period mentioned, 12 to 18 months. But analysts are already predicting this could mean higher drug prices for consumers, obviously, squeezed profit margins for the drug companies, and potential supply chain chaos. That's a really sensitive area, isn't it, given how critical these products are?
It is. And here's the puzzle, right? You'd absolutely expect these growing tariff threats to, rattle the markets, send things tumbling. Yet what we're seeing is surprisingly positive reactions, almost counterintuitive. Despite all these announcements, U.S. stock markets, S&P 500, NASDAQ Composite actually notched new all-time closing highs on Thursday. CNBC reported that. Even the Dow gained. And President Trump himself explicitly linked those stock market gains to the tariffs. We also saw U.S. Treasury yields moving higher on Friday, again, according to CNBC.
It seems backwards, doesn't it? Bloomberg noted there's a noticeable tariff fatigue setting in. The VIX index, the fear gauge, it dropped to its lowest since February. So how do we make sense of this apparent disconnect between the scary headlines and, well, the market just shrugging it off?
Yeah, that really raises the key question. Are markets genuinely pricing in, like, perfection? Or is something else going on here, a bigger picture? I think the key insight might be that a lot of traders are now interpreting these tariffs differently, less as concrete economic threats and maybe more as a high-stakes negotiating tactic, a way to push through trade deals faster. This tariff fatigue you mentioned suggests investors might be looking past the day-to-day noise, trying to anticipate the strategic endgame. As Bloomberg pointed out, some strategists think this whole back and forth is designed to accelerate trade deals. One Treasury Secretary reportedly even described it, and this is quite blunt, as a F around and find out strategy. Provocative, to say the least.
Wow, okay. That's certainly one way to put it. But behind that bluntness, there's a serious question, right? How can businesses possibly plan for this kind of unpredictability? Let's pivot to that real-world impact. How are companies and even entire countries trying to adapt to this constantly shifting global trade chessboard?
Well, it's actually a fascinating study in corporate resilience and strategic national maneuvering. We're seeing a whole range of responses, everything from big companies just absorbing costs for now to countries trying to forge, unexpected new alliances.
Okay, like Levi Strauss. CNBC reported the jeans maker actually raised its full-year sales guidance. They said they plan to absorb some of the tariff costs, at least for now. CEO Michelle Gass noted their business is strong enough that they can pull back on promotions, maybe price some new innovative fits at a premium, basically finding ways to offset the tariff headwinds. And probably helps that a lot of their sourcing is already in Southeast Asia, right? And 60% of their business is outside the U.S. Gives them some wiggle room.
Exactly. And then there's Starbucks. CNBC mentioned they're navigating this too, especially with those potential Brazil tariffs hitting coffee. Now, some analysts are apparently a bit doubtful about the valuation of Starbucks' China business, just given the intense local competition there. But Jim Cramer, he highlighted Starbucks' sheer scale. His point was they're probably better positioned than smaller competitors to find cheaper coffee sources somewhere else in the world if needed. It's sort of a classic example of how big companies can leverage their size when things get disrupted.
Right. Meanwhile, shifting to the auto industry, Reuters reported that Ford struck a deal over in Germany with the IG Metall Union, basically protecting all jobs at its Cologne site through 2032, mostly through voluntary buyouts and things like that, to hit their restructuring goals without forcing layoffs. Seems like a strategic move to keep labor peace in a tough environment.
Yeah, definitely. And beyond just individual companies, we're seeing these shifts in international trade patterns too. Take the UK economy. According to CNBC, it actually contracted unexpectedly, 0.1% in May, after already shrinking 0.3% in April. That weakness, mainly in production and construction, was linked directly to U.S. tariffs and all the business uncertainty. But here's the twist. Despite facing a 10% reciprocal tariff from the U.S., the U.K. somehow managed to strike a trade deal with the U.S., making it the first country to actually do that amidst all this ongoing friction. That's a pretty significant development, you have to say.
That is quite a feat, especially when you hear about other trade talks hitting roadblocks. Like Reuters highlighted that talks between India and Australia have stalled, specifically over dairy and alcohol tariffs. India is apparently pushing back against Australia wanting deeper cuts, mostly because of pressure from powerful domestic farm groups there. It's just a really clear example of how domestic politics can totally shape international trade negotiations, right?
Absolutely. And one more from the auto world, this time in Japan. Reuters reported Nissan is talking to Honda about potentially supplying cars to Honda, but in the U.S. They're looking at maybe using Nissan's underutilized plant down in Mississippi, the Canton plant, to build Honda pickup trucks. This comes at a time when business conditions are challenging for both of them, obviously, and U.S.-Japan trade talks are ongoing. It really highlights how companies might turn to strategic partnerships out of necessity in a tough market.
If you connect all these dots, it really paints a picture, doesn't it? How companies and whole nations are scrambling, really, adapting or sometimes struggling to adapt to this constantly changing global trade scene. It's like a complex dance, risk mitigation, strategic partnerships, dealing with domestic political pressures, and every move seems to have ripple effects far beyond just the company's bottom line.
Okay, now here's where I think it gets really interesting. Beyond the sort of traditional trade and market stuff, technology and these new investment areas are making some pretty significant headlines. They're really hinting at how the future of work and finance, too, might be evolving quite rapidly.
Oh, absolutely. The pace of innovation, particularly in AI, and just the growing mainstream acceptance, or at least attention, given to digital assets, it's creating entirely new frontiers for investment, yeah, but also raising some really critical questions about their broader impact on society. Let's kick off with AI and the workforce. This story from CNBC about Goldman Sachs caught my eye. They're piloting an autonomous software engineer named Devin, apparently developed by an AI startup called Cognition. Now, Devin is designed to handle complex, multi-step jobs, and the idea is it will augment Goldman's, 12,000 human developers. With talk of potentially boosting productivity 3 or 4 times over, it obviously throws up big questions about what a hybrid workforce looks like, and frankly, anxieties about job displacement. Bloomberg Research even predicted something like 200,000 bank jobs could be cut in the next 3 to 5 years because of AI. That's huge.
It's a really powerful example, isn't it? AI moving beyond just simple automation towards, well, genuinely autonomous agents. And related to AI leadership, CNBC also reported NVIDIA CEO Jensen Huang recently met with President Trump at the White House, which is interesting timing given NVIDIA just hit that massive milestone, first company ever to close trading with a market cap over $4 trillion. Incredible number. Of course, NVIDIA is also navigating those U.S. export controls on its AI chips going to China. That could affect billions in planned orders, apparently. And interestingly, Trump specifically pointed to NVIDIA's stock rise as like a positive result of his tariff policies, connecting those two things.
Then there's the world of AI chatbots themselves. CNBC detailed how Elon Musk's chatbot, Grok 4, has been getting attention. Apparently, it seems to be consulting Musk's own views, searching his posts on X before answering controversial questions, things like the Israel-Palestine conflict or the NYC mayor race. This comes after its predecessor, Grok 3, had issues generating inappropriate content. It just really underscores the technical challenges and also the bias issues involved in developing and training these AI models. What data are they learning from?
Exactly. And just looking at the broader AI investment picture, CNBC noted that shares of Anthropic, they're the company behind the Claude AI, have almost doubled in value on the private market just since December. They're attracting huge investments from big tech names like Amazon, Bessemer, Cisco, Google. It really shows there's still incredibly strong investor confidence in the AI sector's growth potential despite some of these concerns.
Okay, shifting gears now to crypto. Wow. Bitcoin has just kept on climbing, hasn't it? According to CNBC, it set another new all-time high, breaking above $113,000. And it's held above $100,000 for over 60 days straight now? And it's not just Bitcoin. Altcoins have been joining the rally too. Seems like broader strength across the crypto space.
Yeah, and this surge is happening right alongside some significant action or potential action in Washington. Investopedia highlighted that the U.S. House has designated next week as Crypto Week. They're planning votes on several key pieces of legislation, things like the Genius Act, that one would let private companies issue stablecoins backed one-to-one with liquid cash. That's already passed the Senate, actually. Also on the docket are the Digital Asset Market Clarity Act, which is trying to set up a comprehensive regulatory framework for crypto, and the CBDC Anti-Surveillance State Act. That one would explicitly stop the Federal Reserve from issuing its own central bank digital currency, basically a Fed-controlled digital dollar. So big moves potentially coming on the regulatory front.
And speaking of central banks, but looking internationally, Reuters reported that Goldman Sachs is predicting the Bank of Japan might start gradually selling off its massive holdings of exchange-traded funds, ETFs, starting around fiscal 2026 or 2027. The estimated pace is somewhere between 600 billion yen and 1 trillion yen a year. It's designed as a slow, careful strategy to minimize losses and market disruption as they unwind that ultra-loose monetary policy. It's going to be a long process.
A very gradual unwind.
Yeah.
And finally, for listeners maybe looking for more direct investment ideas, CNBC featured Jim Cramer's lightning round picks again. He recommended SoFi, American Express, and Fair Isaac. Suggested waiting for a pullback on Lincoln Electric, though, and preferred CrowdStrike over Okta. He also highlighted what he called high-quality stocks that might be buyable at a discount even with the market at these highs. Names like Costco, Home Depot, McDonald's, and Starbucks came up. Always interesting to hear those specific takes.
Listening to all this tech and crypto news, it really raises a fundamental question, doesn't it? As AI is reshaping entire industries and these digital assets are grabbing mainstream attention, how do we actually balance this incredibly rapid technological change and, let's face it, market speculation with the need for thoughtful regulation and finding a clear path forward for both the global economy and, frankly, for individual careers? It feels like a real frontier full of promise, but also, significant unknowns.
Okay, stepping back a bit now. Beyond just the raw market numbers and the tech buzz, these headlines we've been discussing also reveal some fascinating shifts happening in the broader economy and even in society. They really prompt us to consider that bigger picture context.
That's right. It's a good reminder that these economic forces, they don't exist in a vacuum. They're deeply tangled up with social trends, political currents, and they influence everything from global energy policy right down to our everyday living costs. Take the OPEC seminar, for example. It's a biennial event recently wrapped up in Vienna. CNBC reported the focus was on energy investment, security, and that ongoing green energy transition. But what was also notable were the protests happening outside the venue, the Hofburg Palace.
Yeah.
People calling for an oil embargo, closure of the Strait of Hormuz, all in support of Gaza. It just starkly highlights that intersection of geopolitics and energy markets. The Iranian oil minister also spoke there, emphasizing the risks that armed conflicts pose to crude oil markets, a very complex global chessboard indeed.
But shifting to the domestic front here in the U.S., CNBC reported on President Trump's proposed big, beautiful bill. It includes some pretty significant changes for homeowners. It apparently terminally locks in the current $750,000 cap on the mortgage interest deduction. And it brings back the deduction for private mortgage insurance premiums. But maybe the most critical piece for many people is it temporarily raises the cap on the state and local tax deductions, SEL. That covers things like property taxes, state income taxes. The cap goes from the current $10,000 all the way up to $40,000 per household. That's just for tax years 2025 through 2029, mind you. But still, that's a potentially huge change. Could save homeowners thousands, especially if you live in a high-tax state.
Interesting. And then there's this ongoing saga around the Federal Reserve's management, or maybe mismanagement. CNBC detailed how the White House has accused Fed Chair Jerome Powell of mismanaging the budget for the central bank's headquarters renovation, alleging a $700 million cost overrun and claiming planned luxury features were omitted. This whole incident has naturally raised questions about whether President Trump might use it as a pretext to try and remove Powell, continuing that pattern of public criticism we've seen. The reporting also touched on this interesting contrast, between the economic theory of homo economicus, the idea that we're all perfectly rational economic actors, and that, the real world irrationality we sometimes see in human behavior, even in managing huge financial projects, apparently.
Yeah, it's quite the story. And finally, maybe ending on a slightly unexpected bright spot in the automotive world, Tesla over in Norway. CNBC reported Tesla saw a huge jump, 54% year on year in new car sales in Norway just in June. The Model Y was apparently particularly popular. And the reason seems to be fueled by its competitive price point there, plus features that just really suit local demand. Things like lots of luggage space, high ground clearance, all-wheel drive, even a tow hitch. It's interesting because this success seems to defy that broader Musk backlash that's been reported in other parts of Europe. It really shows that sometimes practical features and local demand can still win out over broader sentiment shifts.
It really is fascinating when you look at all these threads together, how these seemingly separate headlines, trade policy, political spats, energy debates, consumer choices in Norway, are all actually part of this much larger tapestry, right? The global economy and society. From tariffs affecting the price of goods you buy, to the very human drama of political accusations, to how we power our world, how our preferences shift. It just really shows how interconnected everything truly is, and why, staying informed across all these different areas is so valuable for you, the listener.
Absolutely. And maybe to leave you with a final thought to chew on, considering how the market seems, almost strangely calm, sanguine, you might say, in the face of these escalating tariff threats. And you couple that with the incredibly rapid integration of AI into finance, plus all the ongoing geopolitical shifts we touched on. How much of our economic future, do you think, is actually being shaped by these explicit policy decisions we hear about, versus how much is driven by the less predictable currents of market sentiment, herd behavior, and just sheer technological disruption? What stands out most to you from everything we've dug into today?
Something to definitely think about. On that note, we'll see you all Monday morning with new headlines from major financial magazines.